taxes are a concern. So we have a lot of people, they do their own internet research, and they're like, oh, if I do a short sale, I'm going to pay taxes on the amount that the bank forgave. That's true, that's a possibility, although most people don't end up having to owe taxes, as long as they talk to a knowledgeable accountant. There's one definite, a second possible exemptions to owing taxes on debt forgiveness. So the way the IRS code says is somebody gave you money, but you had to pay it back. That wasn't income. Now they say you don't have to pay it back, so that was income. So now you have phantom income from this debt forgiveness, and it's treated as ordinary taxable income. It gets added to your adjusted gross income if you don't qualify for an exemption. The exemption that most homeowners that are needing to do a short sale qualify for is called insolvency. If they have a negative net worth, meaning more outstanding debts than the value of their assets, they can use the insolvency exemption not to owe any taxes on debt forgiveness. If they don't have a negative net worth but have a very low positive net worth, they could potentially reduce the amount of taxes that they owe but not completely eliminate it. They really need to talk to an accountant because there's a pretty detailed financial calculation they have to do. And unfortunately, for the insolvency calculation, they include retirement savings as an asset. So people that have significant, like 401k, oftentimes will owe taxes because they won't qualify for insolvency. The other possible exemption has expired several times over, keeps getting extended after the fact. It has not been extended for this year yet. There are bills out there, so who knows whether they'll extend it again. It expired the end of 2016 is the last time it expired, and they didn't renew it until February of this year. It made it retroactive to cover last year. That was the latest that had been extended. The previous two times it was extended, it was done in December of the year where it had expired the year before. So you went through the whole year not knowing if it was going to be extended or not, and then last minute it was extended and made retroactive. This year was the first time they did it after the tax year had already started. It was actually included in the bill that ended the government shutdown. So we don't know. It's probably not going to decide again until December of this year whether they extend it or not. That particular exemption, I think most real estate agents have heard of, was the Mortgage Debt Forgiveness Act. It was basically if you did a short sale on your primary residence and the mortgage was a purchase money mortgage, then you could claim this exemption and not owe taxes on any debt forgiveness from a short sale or whatever else, if you did a deed in lieu or if you got foreclosed on and the bank decided not to pursue the deficiency. So it had to be purchase money mortgage on your primary residence. Primary residence is you lived there 2 out of the last 5 years. Purchase money mortgage is the mortgage you use to purchase the property or improve the property. If you refinanced, but just for a better rate and you didn't cash out, that still qualifies. If you had a home equity line of credit to do a whole bunch of repairs to the house, that still qualifies. So that exemption a lot of people used, especially if they didn't qualify for insolvency, but they met that requirement. But it's expired. We don't know if it's going to be extended again or not. If it's not, we're left with just the insolvency exemption. So sometimes you hear from people, well, why am I going to do a short sale? I don't want to owe taxes. I'll just let them foreclose. Foreclosure doesn't get rid of the taxes. Best case scenario in the foreclosure is the bank decides not to pursue the deficiency, in which case it's forgiveness of debt. You still get a 1099-C for the debt forgiveness. So just letting it go to foreclosure doesn't take care of the possible tax consequences.
So they'll either owe taxes or there's a possibility of a deficiency judgment.
And they come after them for the money.
And they come after them for the money. So either way, they're probably going to have to pay. So it's definitely something that is not going to be in their best interest if they just say, it doesn't matter, I won't owe the taxes if I just let them foreclose.
They can't just put their head in the sand. The problem's not going to go away. It's just going to transfer to the IRS.
And that's worse. Honestly, some of these IRS liens are worse.
Yeah.